Gardiner with Profound Financial, and this is a three-part series on entity structuring and the best entity for you in terms of saving taxes. Entities, in terms of choices, you have very basic, which is what a lot of people start with, which is sole proprietor. Or if you go into business with somebody and you don't really formally organize, then you're in what's just default use as a partnership. Those are the easiest entities to set up because there's no filing requirements. You might have to get a trade name at the Secretary of State, but there's nothing that really requires you. A lot of banks are requiring you to do that, but there's nothing else that requires you to necessarily go get a business license, unless you have like sales tax requirements or things like that. Sole proprietorships are the worst choice in terms of legal liability. There's absolutely no legal protection for sole proprietors. It's not the best choice for taxes because 100% of the income that's generated from a sole proprietorship is subject to self-employment taxes, which may be a very bad thing if you generate a lot of income. The other problem with the sole proprietorships from a tax basis is the audit risk on sole proprietorships is a lot higher, especially if the income is high. If you have a gross income of more than $250,000, you're in a very high audit category compared to having that same income on a partnership tax return or an LLC. So they're the easiest to set up, but they're more risky from tax perspective. They're more risky from legal liability perspective. Partnerships are also pretty easy to set up. You fill out what's called a 1065, it's a partnership tax return, and you share the income with your partner based on your agreement, which a lot of times is in kind of casually formed partnership, it's verbal. So it might be 50-50 or 60-40, whatever that is. Each partner is given a K-1, which allows them to take the taxes, the liability onto their personal tax return, so that income is passed through. Again, the income is subject to 100% subject to self-employment tax, so you don't get any break from there. But your audit risk is a little bit less. From a legal liability perspective, partnerships are just as bad as sole proprietor because each partner is liable for the actions of the partnerships. Stay tuned for the next one, which will be on S Corp and LLC.